Hi everyone, this is OK Manuel, and today as I promised earlier, I will be taking you through the beginner's Forex course. Now I don't know how many sessions or lessons it's going to take me to complete this course, though it's quite a lengthy one. But we'll do it from time to time. So don't forget to always stop by, check in. I'll be releasing other contents at least twice a week. That way I will be able to cover most of the courses I'm supposed to cover, at least from beginner to intermediate to even advanced trading. So like I said earlier in the other video, you can also drop me suggestions telling me topics you would like me to cover, and I'll be glad to do so. Thank you very much. Without much waste of time, let's delve into the business of the day. So I want you to look at the Forex market as a business. Just like every other business out there, you can venture into once you have your capital. Now, but aside having your capital, because in most cases, in every business, it's not just about the capital, but the passion first, and then the knowledge, the technical know-how. So, I want you to know that basically all that happens in the Forex market is mostly about buy and sell. You buy low, you sell high. You buy low, you sell high. Now, take for instance any business out there where any seasonal business out there whereby there are seasons when it's cheap, and then probably after being stored for a while, then it's been sold for at a better price or at a higher price. Now, that's just like how the Forex market is. You can buy in expectation that prices are going to go high. So now, just like in every other business, you can buy and then just to discover that your projection was wrong. So it's normal in every business, but the most important thing is that you come out, you emerge successful at the end of the day. So now we'll talk about the history of Forex. Now, for the history of Forex, back then, earlier on, that's about 500 years back, that's about 5 centuries, there was no standard means of exchange. There was no standardized commodity or asset that is being used for transactions. So, although Forex mostly started from Amsterdam, and then coming down to the metal age, that's when gold and silver now became a standard medium for transaction, until at about 240 years back, that's almost 2.5 centuries back, when gold now became the standard for exchange. Now, along the line after the World War, gold was dropped, and then the US dollar became the standard medium for exchange. So, and that explains why most pairs are usually, most commodities, most assets, stocks are usually paired against the US dollar. So, now you can also see or check for yourself, make your findings. You will understand that it's the largest market in the world, because over 6.6 trillion US dollars is being transacted daily on this market. That makes it the biggest. Yeah, this data is from the Bank for International Settlements, and that was at around April 2016. That was when there was a boost in the market. Previously, it used to be around 5 trillion US dollars. Not until now. So, what am I trying to say here? It's a market that there is unlimited opportunity. There's an opportunities for everyone. You can make money regardless of how it is. You know, far back then, you and I as an individual cannot actually trade Forex. But thanks to the advent of brokers, you and I can actually, through the help of leverage, trade and earn money. So, with that being said, let's proceed and see how it's going to be. So, what is Forex? Usually in school, they will always want to define whatever term or anything it is, the subject matter. So, since Forex is the subject matter, Forex simply stands for the word foreign exchange. Now, it's basically an act of exchanging one currency for the other. Now, unlike in every other market, in the Forex market, it is always open for business 24 hours. And this is because there are different trading sessions. We will also come to that when we get there. And then, more to it is, you can trade Forex and make money. Now, you don't really trade within the weekends, and that's because, you know, most transactions are done during business days, so we don't have to really bother about that. But in every other business, there are public holidays. Now, in the Forex market, there are only 2 days that are being stipulated as a public holiday, and these are the Christmas Day and then the New Year. Now, this is so because you know fully well that we are trading currencies from different countries. So if this country is on holiday, is observing a holiday, the other country is not on holiday, or other countries are not observing any holiday. So, and that's why it's like that. And the major aim of every broker is to make money. Yes, money. But come to think about it, as you begin to grow as a trader, as you begin to become more advanced, this is going to change, because your number one goal will change from becoming making money to, first of all, protecting your assets. So that's by the way. So next, we'll be talking about the commonly traded currencies. Now, it's true that we are trading currencies, we are dealing with currencies in the market, but we are not trading every currency. We're not trading every currency because there are some that are mostly being traded, there are some that are not stable, so because of the rate of their economic growth. So basically, there are most commonly traded currencies in the world and in the Forex market, and that's why what I'll be showing you in a moment. The euro, which is denoted by the 3-letter EUR. So next to the euro is the dollar, the US dollar, United States dollar. So now next is the Canadian dollar, the Great British pound, the Japanese yen, Australian dollar, the Swiss franc, and the New Zealand dollar. Now, it's important you know that the whole of these currencies are not traded on their own. Usually, we don't, in Forex markets, currencies are being traded in pairs. And when currencies are being traded in pairs, it is so because it enables that, in fact, to me, that is what enables the forex market to become as consistent or as continuous as it used to be. So, and in a moment I will show you why it is traded in pairs. Now, one of the major reasons even is because in the forex market, whether you are buying or selling, you are making money. Whether you are buying or you are selling, you still make money. And this is because since you are trading the currencies in pair, as you are buying one currency, you are indirectly, as in you are directly selling the other. That's what it means. If the euro is paired with the US dollar, and then you are selling the US dollar, you are selling the euro US dollar, what it means is that you are selling the euro and buying the US dollar. So I will also go about that. We'll show you that in a moment. So now transactions are usually quoted as in pairs, and then you can see it just as it is over there. Now let's say, for example, if euro US dollar has an ask price of 1.3125, you can buy 1 euro for 1.3125 US dollars. That's what exactly it means. Take for instance, you go to an exchanger, and then euro, as at that time the euro is trading, the euro and the US dollar is trading at a particular price, let's say 1.3125. Now what it means is that for every 1 euro you present, you are going to get 1.3125 US dollars. Take for instance US dollar Nigerian naira. You go to an exchanger, you present him with $1. For every $1 you present to him, you get like 400 naira. That's depending on the exchange rate as at that time. So that's by the way. Okay, with that being said, we'll proceed to the next one. Pairs traded in the forex market. Now, like I told you, it's not every pair that is traded in the forex market regularly. So now we'll be talking about the different pairs that are traded in the forex market. Now basically, pairs that are traded in the market are grouped into three, and these are the majors, the minors, and the exotic. Now in the major pairs, what is happening here is this. Let me show you an example of it. Basically, how the majors came about is this. Any pair that is being, any currency that is being paired with the US dollar and is being commonly traded, paired with the US dollar and commonly traded, is regarded as a major in the forex market. Now there are other exceptions. Some other platforms represent some other pairs also that are not really paired with US dollar. They are paired they are paired with other pairs as others apart from the US dollar, but they are regularly being traded. They are most commonly being traded in the market. So that's why that was how we came about this Euro GBP, Euro JPY, and AUD JPY. Now the second one is the minors. Now the minors include GBP AUD, CHF JPY, CAD JPY, NZD JPY, AUD CHF, and lots more. What is happening here is that among the list of those pairs I showed you, I gave you earlier on, that's among the list of the currencies that are being traded that I gave you, apart from the US dollar, any combination, any pairing between these, any ones among them is usually regarded as minors. and have been frequently traded. Now, for the exotics, we are referring to some of those countries that are having an emerging economy, those emerging economic nations such as Brazil, Mexico, Denmark, India, and that's how we came about them. So whenever they are being paired with the dollar or with the euro or with the pound or with any other this thing, like for the Nigerian naira, I don't know, they call it Nigeria. Some brokers will just tag it as Nigerian derivatives. So I don't know where to really place it, but I believe with time it will come up into the exotics. So an example of such are the USD ZAR, that's the US dollar South African rand. So US dollar MXN, US dollar Norwegian krona, so to say, US dollar SGD, US dollar SEK, US dollar INR, that's the Indian rupee, and then GBP INR, and so many of them. Now there are some nicknames that these pairs are being noted for. In case sometimes you hear someone talking about the word, you just hear someone say going long on dollar Swiss, or I am buying the pound dollar, or I'm selling the euro dollar. What he's actually trying to say is, like for a good example is the US dollar Japanese yen, or the GBP JPY, that's GBP Great British Pound Japanese Yen. Now Great British Pound Japanese Yen, you can call it the pound yen. That's another nickname that is being known for, the pound yen, the pound Aussie, that's GBP AUD. You understand? So, and that is how it is. We have the Kiwi dollar, that's NZD US dollar, and lot of them. The pound Kiwi, GBP, NZD, and so many more. So that is how it is. So next we will be talking about, so you can see the Aussie dollar, which is the Australian US dollar. Next we'll be talking about buying and selling on the Forex market. Now, like I told you, the major thing we do in the Forex market is simply buying and selling. You buy low, you sell high. But like I will always say, as you keep growing, that will also change, because there are times you buy higher and sell lower. Don't worry, that's not for today. It's quite advanced. So, buying and selling model is an easy process for the novice trader. Yeah, I could remember when I started earlier on, I could just hit the buy button and the sell button. So hit anyone and I get the results. So, but you have to be guided in whatever you're doing in the Forex market. Now, what is happening is, just like I said earlier on, when you're buying one currency, you are directly selling the other currency. And this is a perfect example. Let me grab my laser. Now, I want you to look at this thing in this way. Here is the euro, here is the US dollar. Now, this is what you'll be seeing in any platform, most platforms you'll be trading on. You see the euro, you see the US dollar, or you see the GBP, or you see and then the US dollar, depending on whatever pair it is, if it's an exotic pair, major pair, or a minor pair. Now, what is happening, like I said, as you are buying, let's say you're on the platform. In fact, let me in a moment show you what it looks like on the platform. Okay, so the example I'm trying to cite here is this. You can look at this. Let me take it to something. This is an example of a chart, and this is what I'm talking about. With time, I will, when in another lesson, I'll be teaching you technical analysis proper. So don't worry about whatever you're seeing here. I could remember when I started, it was really crazy. There was nothing, I couldn't understand nothing, anything, whatever that was going on here. I was just seeing those bars printed there. But I'm going to take you through it. It's a gradual process. It's important you understand the basics first before we begin to talk about technical analysis, how to read the charts and all those things. I will show you clearly, and believe me, you are going to learn it and you're going to enjoy it. So now, what I was trying to talk about is this. You can see clearly it is a live market. If you look very well, you can see that you will see the buy and the sell button, and this is the one I will not, I'm so tempted to go into that, but I will not be going. I just wanted to show you what it looks like. Sell and buy. You look at what is happening here. The prices are changing, and the smallest of this is what we trade in the market, and you can see that is why it is being boldened. You can see how bold it is. You can see how bold it is. So any one change from here is referred to as PEEP. Is referred to as a PEEP, as PEEP. Now, sell, buy. This is Euro GBP. As you are buying, as if I decide now, I say, okay, this is the Euro pound. I want to sell the Euro GBP as a pair. As I am selling, once I hit this button, what I am doing is I am selling the, I believe that from my forecast, from my projections, that the euro is going to lose value and the Great British pound is going to appreciate in value. So once I hit the sell button, I am selling the euro, and at the same time I am buying the Great British pound. Now we'll go back to, let's switch back to what we're doing now. So the same thing goes for Euro US dollar. If this is the current price of Euro US dollar, and usually the prices are different because we have the quote, the bid and the ask price. So I will be coming to that. But just bear in mind that when you say you are buying in the Forex market, you are buying the base currency and you are selling the quote or the counter currency. So like here now in euro, in the case of Euro US dollar, the euro is the base currency and the US dollar is the quote currency. So you can see this is the base currency and this is the quote currency. You can see it's just very clear and very simple. I believe you understand. If you don't understand, you can go over the video quite a number of times and just make sure you understand this before we proceed. You proceed to the next video. So that's it. Common terms used in Forex trading. Now, like a PEEP, like I started mentioning earlier on when I was in the MetaTrader 4 platform. A PEEP is the smallest price movement of a traded currency. It is also referred to as a point. Especially mostly in the stock market, they are referred to as points. Now, it's very important that you understand what a PEEP is in the Forex market, especially when you want to start trading, because this will help you know whether you are making progress, whether you're profiting or you are losing. So everybody in every business venture, we want to at least know whether he or she is actually making profits or losing. So you will know whether you are to continue or to back up. So now here is an example. For most currencies, a PEEP is 0.0001 or 1/100 of a cent. When a currency moves from a value of 1.0922 to 1.0928, it moved 6 pips. Now I didn't really take note of exactly where exactly the market was for the Euro GBP example I was showing you in the live market, but what it means is whenever, since we are dealing with the last two, remember the last two bold numbers I showed you on the MetaTrader 4 platform, these are the pips. And when you go to an exchanger to exchange money, he is giving you 1.09. Let's say euro at that moment before you came was 1.09 for the before you met the exchanger for exchange, and then regardless of what is happening in the market, that's what we now are doing, because what we are trading in the forex market are these pips, the smallest points. These are the things we are trading. That was why I told you it's very earlier when forex trading started. It's very difficult for an individual to make money trading forex, because imagine how much you will have to make if you're going to be dealing with these tiny things, these tiny points. So, but that's not what we're talking about now. Thank God for the advent of brokers. With them, at least with the help of the leverage system, you can invest just $1, and then the company or the broker will, on your behalf, invest over $100, or depending on the leverage system. So, in a nutshell, what I'm trying to say here is this: since we are dealing with PIP, whenever a market moves for any amount of PIP, the usual standard, the normal standard we use in trading of a PIP is for a standard. So the standard of trading in the forex market is $100,000, which is known as one standard lot. Now, when we go to lot, I'll explain that better. So a standard lot is $10. So imagine in this market now, like this market moved from 1.0922 to 1.0928, it moved 6 pips. So if you multiply 6 by $10, because one standard lot is $10 for each 1 pip movement, you gain $60. So cool and very simple. Now there are exceptions in this rule, especially for the Japanese yen. Its PIP is not calculated like in 4 decimal places, just like the way it is in other currencies. It's usually in 3 decimal places. So, another example is you buy one standard lot of euro US dollar at 1.0921. The price is moved from 1.0921 to 1.0929. What will it be? This is the calculation. Very simple. You subtract the 1.0921 from 1.0929 and get, you can see now, is the last number, which is 8. That's what we are using now. Multiply by one standard lot, which is 100,000. That is equal to $80. Very cool and simple. That's how you make your money. Let's go into live charts. Let me show you what I mean. Now, let me go down to a smaller time frame where you'll be able to understand what I'm saying. Now, take for example, look at what is happening here now. You can see, let's assume this market is kind of volatile. I don't know, probably there is a news event that is going on currently. Let's mark it with green. We love green, lemon green. Okay, line. Let's go. So you can see now. Look at what is happening. I want you so that we'll be able to calculate the price, and then you see and understand what I'm talking about. So the market was at this point before the candlestick came down. Now if you notice, did you notice that it hit our point? Yes. Oh yes, it did. It did hit our point. Now let's calculate. You can see our point was that's 0 GBP, 0.898289. Now let's look at, you can see where it is at exactly 0.89828. Now we are not really considering the last one there. Like I said, we are dealing with the in the case of 5, we are calculating, we're going to be using 4. In the case of 5, we're going to be using 4. So if you look at it, you can see, let me pull up my calculator as well so I can show you this thing very easily. And pull out my calculator. So let's do this math now. The market, oh my god, this market is so volatile. Can you imagine? You can imagine what it's doing. You can imagine. Now you just hear what the whole of this thing happened. In fact, let's change our target, because since you were with me when this whole thing happened, let's change our target. The market started from this point to this point, so that you will see what I'm trying to tell you, how profitable the forex market is, and then so you will know that you're not losing if you be going into the forex market. So let's mark the points. So from here now, the market was at this point, and then it got to this point. So 0.8996 0.8996. Now 0.8996, we are subtracting 0.8996 from 0.8979. 0.8979. Can you see? Now this, in this market now, what happened clearly here is that the market has moved 17 pips. So imagine you were trading one standard lot in the market. One standard lot in the market is simply 10 multiplied by 17. You see, 170 US dollars. Just within split seconds. Like I told you, if the market is volatile, I will show you how to manage your account, risk management, and all those things. I'm just trying to show you how profitable the forex market can be. So that's by the way. Let's proceed. Now, I believe we are clear on what a pip is and how it affects your profits and your losses. So next, we'll be talking about the bid and the ask price. Now, I like to always go to the platform to show you what these things are. If you remember on the platform, you always see that there is a number by the left and by the right. Now, the numbers on the left are usually known as the bid price, which is the price at which you as a trader is willing to sell. Is usually the lowest price. And then the ask price is the price at which you as a trader is willing to buy. Now, look at it in this way. The broker is offering you this, and then there is, if you notice, 1.43 to 1.45. There is a difference of 2 pips. If you do the subtraction, there is a difference of 2 pips. So, and that 2 pips is what is referred to as spread. Now, there are some apps that will show you. If you noticed on my platform, you would notice as a tiny number at the top right that was showing, that was changing. That's the number of pips. It varies depending on the volatility of the market. So the bid is the lowest price of a currency quote that a seller or an individual is willing to sell. Just like I said, same thing as the ask. This is the highest price of a currency quote that a buyer or an individual is willing to buy. Now, here is a picture. In another platform, this is what you will see, mostly other web platforms. You can see something like this, or whatever trading platform you're using. So this is what it looks like. So this is the bid price and this is the ask price. Usually one is higher, and that is the buy price, the price at which you're willing to buy. So as you're buying, what it means now, if I say I'm going to buy euro US dollar, I'm buying the euro and I'm selling the US dollar. So Let's proceed. Now, the difference between the bid and the ask price is usually known as spread, and this spread is known as the cost of, in fact, is the cost of doing business. That is what the broker charges you, whether you make profit or not. This is what they charge you for, as in borrowing their money to trade with. Remember, I told you they invest more on your behalf. You invest $1 if you're using leverage 1:500 on your behalf. For every $1 you're investing, the broker is investing $500 on your behalf. So imagine all they charge you. Like for most commonly traded pairs, the spreads are tighter, especially for like euro US dollar. Sometimes there are places you may even get just 1 point something pips spread. So it all varies. There are pairs that have as much as 17 pips spread. So, and what it means is that before you even, once you enter a trade, either buy or sell, you must cover for that commission charge, that spread. You must cover for it, whether you are losing or you are gaining. In fact, before you even break even in any trade, you must have to pay up for that 2 pips. So let's say you bought on the euro US dollar and this was the current price of the market at the time you were buying. What it means simply is this: when you were, at the moment you hit that buy button, you will have to automatically, it will show you that you are on negative 2 pips. That's minus 2 pips. So if the market goes in your direction, in your favor, at least you have to pay up for that 2 pips before you will at least say that you've broken even. So I believe that is very much clear. So let's continue. Let's proceed. So I believe I've talked about a lot, but let me go deeper now. A lot, we said, is the minimal traded amount for each currency transaction. Just like I told you earlier, then when trading started, you and I cannot trade Forex. It's for an individual. It was mostly institutions that were trading Forex. And that's simply because of the high amount of money that is being required to trade Forex. So, but now things are easy, and then look at the volume of the market, and I don't know, if you don't trade Forex, what else should you trade? The market that is always open there. You can always make money. Imagine how much you can make from 6.6 trillion US dollars every day. It's up to you with your strategy. So, but with time, patience, and the right skill, the right knowledge, you're going to emerge successful. So, when we talk about lots, now, since brokers came in, they were able to make the thing easier, the trading easier for at least individuals like us. Now we have what we call the mini lots instead of the standard lot, which is 100,000 US dollar or 100,000 units. Now I've been saying US dollar units. Now, however, you can also open mini or micro accounts, just like I said. Mini accounts where, since you're not an institution, you can just trade mini lots, which is just 10,000, and then for a micro lot, it's 1,000 units. Nano lots can go below at 100. Now, when you're talking about nano lots, we're talking about 100. So that is it. So understanding the pip spread. Now, the pip is usually associated with the spread. Just like I told you, I believe I've already explained this, how it affects whatever you are doing. Especially, you cannot neglect or overlook the importance of this as a trader, because the difference between your buying and selling is sometimes for a scalper. The scalpers are usually those that they don't spend much time in the market. Like for the 17 pips, in fact, it's even too much for a scalper. And a scalper is just targeting 10 pips in the market. That will just stop. He's just targeting 10 pips. So now imagine if his spread is 2 pips, he must have paid up for the pips. As in, if his spread was 2 pips, he will be making at least 15 pips in profit. Are you getting it? 15 pips in profit. So instead of that 170, it will be 150 in profit, $150 in profit. So look at how it affects it. Now imagine that for the pair he entered, he wanted to scalp on. He didn't notice the spread, and then the spread was 17 pips. That is to say, he didn't make anything. In fact, he may have to go into praying and then hoping that the market goes in his favor, so that at least he can even close at break even. Because the moment he enters that position, he is on a minus until he pays off for it. So imagine if he had gotten it right and it was going his direction, he only broke even if the spread was 17 pips. So you have to understand this, because it's going to help you a lot in this business. So now, just like I said, your contracts or whatever position you open must have to cover the spread before you at least break even or even begin to make profit. So the tighter the spread or the lower the spread, the easier it is for you to bank profits. Generally, the more active and bigger markets, the lower the spread, the pip spread, just like I said. The smaller and more exotic markets tend to have a higher spread. In fact, most brokers will be offering different spreads for different currencies, and usually that's how it is. Smaller accounts also, we generally have higher spreads than regular accounts. Yes, they are what we refer to as ECN accounts. They are usually tighter in spread. The larger your account size, the tighter or the smaller also the spread. And it's normal in every business. If you have a bigger capital, you enjoy the business. So lots explained now. Let me explain lots properly. Unlike in the stock market, where 100,000 shares and 10,000 shares are like pretty much the exact number, because in the stock market, if you're buying 100,000 shares, that is what it is. If you're buying 10,000 shares, that is what it is. In the Forex market, things are a bit different, and it will be good you familiarize yourself with it, because if not, you'll be making a huge mistake. So a standard lot in the Forex market is 100,000 units. I've been saying that over and over. A mini lot is 10,000 units. Just like I said earlier, a micro lot is 1,000 units. Then some brokers will even go as low as offering you cents accounts or nano accounts. So a nano lot is less than 1,000 units. So it can range, usually you can use 100. So 100, 200, 300, 500 to 900, less than 1,000. That's what a nano lot is. So you can see now. This is how the derivative of how it came about. One standard lot, 100,000 units divided by 100,000. That's if you're dealing with $100,000 now, that's one standard lot. So a mini lot is 10,000 divided by 100,000. Remember, since basically what we are dividing with is that standard, we are using the standard to make the division. So the one standard lot is being divided with another standard lot. So to derive the mini lot is 10,000 lots, as in 10,000 units, so to say, divided by 100,000 units, which is the standard. So in your trading platform, when you want to place the position, you will see lot size. When you see 0.1, what it means is one mini lot. And what it simply means is that for every one pip movement in the market, unlike in the standard law where it is $10, you'll be making $1 if you do the math, going by the formula I showed you in the last example. For one micro lot, 1,000 divided by 10,000 units, 1,000 units divided by 10,000 units gives you 0.01. That's what a micro lot is. And for every one pip movement, you make 1 cent, not $1. So nano lot, this is it, is 100 divided by 100,000 units. 100 units divided by 100,000 units, which is equal to 0.001. So next is leverage, and how leverage affects your profits and losses. Now, leverage is important to know that leverage is a two-edged sword, and it can be to your advantage, it can be to your detriment. In fact, it's always advisable that you trade, no matter, regardless of the size or the amount of leverage your broker offers you, you should trade at a leverage that your account size can carry. When we go into risk management as a topic, we'll talk about that properly. So now, leverage allows you control more money. I believe I've said that also when we started. For every $1 you are investing, depending on the leverage size, if your broker is giving you 1,000 leverage, it means for every $1 you are investing, they are giving you $100. They are giving you a $1,000. So if you invest $1,000, they are giving you $100,000. So imagine when you go into the market with $100,000. You can see how we are coming back now to that standard lot size that I talked about. So you can imagine that somebody who is trading at a standard lot, for each one pip movement, he is making $10. Or another with a mini lot, for each one pip, he is making just $1. So for 5 pips, for leverage of 5 standard lots, you'll be making like $50 for each one pip movement. So the same thing for 5 mini lots, you'll be making $5 instead of the regular $1 for one mini lot. So it gives you more control of more money, the borrowed money. Now there is a way, somebody may be asking the question, how will they borrow you such a huge amount of money? What if you lose it? Don't worry, that's where margin comes in. It's calculated in such a way that, unlike in the stock market where you have margin call, once you're about to go beyond certain level, they call you and tell you that you should refinance your account. Here, once it gets to certain level where it will begin to go into the broker's money, you are being caught out. So that's why you have to be very careful with the use of leverage. So, for example, if you buy 1 mini lot of the Euro-US dollar currency pair, then your account equity will increase or decrease by $1 for each pip movement. I've said that. And then if the Euro-US dollar pair increases by 10 pips, that is, say 10 multiplied by $1, what it means is, let's say the prices of Euro-US dollar move from 1.3000 to 3010. That's 10 pips if you do the math with mini lots. Then this is a $10 increase. But if it's with a standard lot, it's $100 increase because it's 10 multiplied by 10. So, but for a mini lot, it's going to be $10 increase for 10 pips, because for each one pip you make is $1. Now look at it again. Example 2, if Euro-US dollar pair increases by 10 pips, just like I said, 10 multiplied by $10, that's 10 pips multiplied by $10, from 1.400 to 1.410 with standard lots, then this is $100 increase on your account. You can do a lot of things with $100 increase. So leverage can amplify your wins or losses in different ways. Now, these are examples of leverage. Some brokers will offer as low as 1:3, not all. Others 1:10, others 1:30. Most majority we offer from 1:100, 1:300, 1:500, 1:1000, and many more. Now, here is the calculation. Look at it very well. 1 micro lot. If I have a 1 pip movement in the market, 1 micro lot, what am I going to get? I am going to get 1 cent increase on my account size, because I am calculating 1 multiplied by 0.1. So for 1 mini lot, 1 pip increase is going to give me $1. For 1 pip in a standard lot, I'm going to get $10. Now look at it. For 100 pips in a micro account, For 100 pips movement, I'm going to multiply 100 pips multiplied by 0.1. I'm going to get $10. For 100 pips in a mini lot, I'll be making $100 for 100 pips movement. And in a day, depending on the market situation, you can get up to 100 pips. In fact, in our signal groups, there are times in just 2 days we make 380 something pips, depending. So depending on the market situation. So this is how it is. So 100 pips. Now, whenever the market, let me stress this, whenever the market gets into 100 pips movement, that is when you notice, that's when you get a change in prices. So let's say if the dollar was 1.40 euro, as in if euro is exchanged for 1.40 dollars, whenever there is 100 pips movement in the market, if you go to the exchanger, you will no longer get it at 1.40 but at 1.41. So you should. So next we'll be talking about, let's explain leverage proper, and then after leverage I will pause with the video. In 102, that's where I'll be explaining and showing you types of order, how to place orders, and how the types of slippages, what a slippage means in the market, and what are the causes of slippages. These are all terms that I'll be explaining in the next video. So for leverage, most brokers will allow leverage. Like I said, leverage is a borrowed capital, such as margin, allowing a trader to gain access to a larger sums of capital. This can heighten profits and losses and should be used wisely. I've said it, should be used wisely. In fact, you have to do that. You have to know this. There is always that tendency in every beginner trader to want to over leverage an account. Yeah, that's where mentorship comes into play. In fact, you hardly can succeed in the Forex market without mentorship, even when you're being coached by the best of all coaches. There is always need for mentorship. A mentor will hold you down, especially whenever you're trying to go out of the way or you're trying to over leverage your account or whatever it is. So here is an example. A trader has $4,000 US in his account. If trader A, now that's that same trader, has an account leverage of 10:1 and wishes to use 1,000 out of the 4,000 he has now on one trade as margin, he will have an exposure of $10,000 US. What do I mean? Look at it. Remember, I said they are giving you, the broker is giving you more money than you have deposited to enter the market and make more profit, so you can make more profits. That's what leverage does. It gives you a higher buying power. So with that more buying power, you can buy more and make more profit. And what they just charge you is that spread. That's what you pay for, the commission they charge you for. So 1,000 multiplied by 10, that's the leverage now. The leverage size on their account is $10,000. So he has an exposure or a trade value of $10,000 US. Now, another example will be trader B, who has $4,000 US in his account. If trader B has an account leverage of 1:100 or 100:1, and he wishes to use 1,000, the same. Imagine now, look at it. Trader A used the same 1,000 out of the same $4,000 account size. Trader B is using the same 1,000 out of the same $1,000 account size. But here now they are using two different leverages. Trader A used 10:1 leverage size, and then trader B is using 100:1. Now, when trader A is having a 10,000 trade value, trader B will be having $100,000 trade value, and you know that definitely trader B will have more profits. In fact, times 10 in terms of profits than whatever trader A is having. And that is just how it is. And in terms of losses also, trader B will lose more. We have more losses than trader A. So next we'll be talking about margin. Now, margin is the difference between your capital used as a collateral and the amount that you can trade. Remember I said that earlier on when I was trying to answer the question that some people may ask or may be wondering, what is the collateral? Who does that? Who will just give you his money like that to trade without any collateral? So your capital, your initial deposit is the collateral, and that explains why for every $1 they are investing more for you. So it is calculated in such a way that once it hits certain level, depending, it varies. The margin level varies in margin percentages or closed out levels varies from one broker to the other. Some leave it at 50%, some leave it floating from 50 to 100% depending on the volatility in the market. For example, if an FX trader buys 1 mini lot of US dollar pair for 150 at 1:100 leverage, then they will need $150 now in terms of accounts margin now to maintain that position open. That's what it means. Because since you are using 1:100, so what it means is that your buying power is lower. So you will need $150 US to maintain an open position for a pair, your US dollar pair that is trading at 1.50. So if the market moves that's against you now with 10 pips, then you need additional $160 to maintain that position open. So if on the other hand a trader buys a standard lot at 1.50 at the same 1:100 leverage size, then they will need 1,500 of their accounts in margin to maintain that position. If the price moves against the trader by 1 pip, then he will need additional $10 to keep that position. Remember, leverage pip. 1 pip, standard lot, mini lot. For standard lot is 10 for 1 pip. So just don't forget these things that we've already talked about in past. Remember them, go through the video like I said over and over, so you can at least register it to your subconscious mind, and then with that way you'll be able to have a perfect understanding of what we are doing. So I will be posting this video at this point. If you are yet to subscribe to my channel, please ensure you do so. And then you can also check the free signal group for most of you that have already started trading, or at least are into trading already. You can check the signal group, the free signal group. Join the Telegram channel, and then also join us as we continue to bank profits consistently. So in the next topic, I'll be talking about placing orders, types of orders, different types of orders, and the rest of it. Slippages, talking about types of order. I will explain to you, I will go into the live chart and show you what it is, how it is done, how these orders are placed. I will also be talking about other terms, trading sessions. I'll also be talking about other terms, trading sessions, so you'll be able to know the real time to trade depending on your zone, that's your location. So just ensure you stay to the channel, subscribe, and then hit the notification icon so that once I post the new video, you will get it and then continue to build on your knowledge. So send me emails, drop comments, tell me what you want me to do, tell me the topics you want me to cover, and I will do so. So we will soon be rounding up. Probably in the next class we should be able to round up with this, and I'll begin to treat other things like the technical analysis, fundamental analysis, and every other thing. So thank you very much for staying with me to the very end of this video. See you in the next video. Thank you very much.